What's up, traders? It's Jason here, and today I've got something incredibly special for you. This week I executed a very beautiful trade on volatility 251S index using one of my favorite entry techniques, and that is buy limit orders. And of course, the market reacted exactly as we expected. In this video, I will show you first why I did set buy limit orders instead of jumping into the market right away. Secondly, I will show you how I identified the perfect zone to place my orders. Thirdly, I will show you how I manage my risk while letting the market come to me. And lastly, how you can apply this exact method that I have used to enter into this market so that you too can be able to catch sniper entries without you chasing the price. This isn't just another trading setup, guys. It is a strategy breakdown that could completely change the way you enter into the market. Let's dive right in. The trade was on volatility 151S index, one of the fastest moving, most aggressive indices out there. Perfect for traders who want precision, of course. And here is exactly how I did until I got these buy limit orders. First of all, you have to know and you have to understand the type of trader you are. If you are a day trader like me, then the highest time frame that you should start doing your analysis should be on the daily time frame. Why the daily time frame? Because on the daily time frame, you are going to know the general bias of the market that you are entering. It is a must if you are a day trader to start on the daily time frame. Some day traders, they do doing the analysis on the weekly, some on the 8 hours time frame, some on the 4 hours time frame. But according to my own trading style, based on the knowledge of time frame coordination, I urge you to also start doing your analysis on the daily time frame. On the daily time frame, right here, we wanted to know the general bias of this market that we are trading. And of course, on the daily time frame, you can see this market was moving aggressively to the downtrend direction. Even a beginner trader, if you ask the direction of this market, of course, he or she will tell you that this market is moving to the downside and they are selling. So for the case of those traders who are completely new, let us remind ourselves how exactly the market is supposed to move when it is selling. So I will draw a heading illustration right here, and this is how the market is supposed to move whenever it is moving on a downtrend direction. That are series of lower lows and lower highs. Based on this situation right here, I'm sure you can notice yourself that after the break of the structure, the market always did aim right here to reach it before actually breaking another structure level. And after the break of the structure, the market came, of course, again to reach this right here. Based on this illustration or based on this theory of how the market is supposed to move on a downtrend direction, we also anticipated that this market, after the break of this structure right here, based on our theory, we are anticipating the market to come to the daily liquidity areas before actually selling. So as the market is coming to the daily liquidity areas, you can note that this is the daily time frame. That means on the lower time frame right here, there were many buyers into the market who were pushing this market to the upward direction so that they can come to the daily liquidity areas before actually selling. So that is the perfect story for you to understand. Now, another story that we have to understand that this lot of money, you cannot just stay idle waiting for the market to come right here before you start actually selling, because you can say, sir, although I am a beginner trader, but there are traders out there that they are saying always go with the trend. And clearly we have identified that this market is moving on a downward direction. So why exactly are we buying on the lower time frame where exactly this market is moving on a downward direction? Did you see that your account trend in this market and it is not safe for us? Well, the only answer that I can give you is this: from these points and to the daily liquidity areas are almost 20,000 points. You cannot just stay idle while you are a day trader, meaning you have to trade day-to-day basis. So we are going to see on the lower time frame the opportunities that made us enter in this market. So let us go back on the 4-hour time frame. Right here, we are doing a top-down analysis. Okay, a top-down analysis is a type of analysis where you start doing analysis on the highest time frame while proceeding very slowly with your time frames according to your time frame coordinations. All right, not just any time frame. You have to make sure your time frame they coordinate with each other. On 4 hour time frame right here, scores, you can see the market was aggressively moving on a downtrend. You can see the market was moving very aggressively. It had no time. It was moved very aggressively. But this downtrend market that was moving on the 4 hour time frame came to an end when we got a shift of the market right here. So a shift of the market, had it occurred right here, it gave us a conclusion that, okay, right now, sellers that were very strong, they are losing their powers. All right, they are losing their powers, and likely or possibly, you have to understand these words that I'm using, possibly or probably, the buyers are coming into the market. This does not mean that it is a must. You have to understand that this is just a probability game, all right? This is the logical way of how we trade. This is the second confluence that we note as we were doing analysis on this market right here. And again, lucky for us, the market started to move very beautiful. You can see here we had our first high and the market was moving in sideways. So what does it tell you? It tells you that the market is searching for a proper liquidity area before it is going to buy. This moving of the sideways, logically, it tells you that right now into this market, there are no actual players that have enough money into their account that they can push this market either to the uptrend or to the downtrend. As a retail trader, you have to know where is the exact area where the big players who they have funds into their account that they are large enough to move this market. All right. And that means the concept of liquidity areas, you have to understand that concept. And based on our knowledge of liquidity areas, I did identify that our liquidity areas are at this point right here, and we insert our buy limit orders because we know an area right here, those guys who have millions into their bank account, it's an area where they are likely going into this market. The beauty of understanding the liquidity areas, because you know exactly where the big boys or the big banks are entering this market. All right. And how did we manage our risk? How did we place our stop loss? We said our stop loss, it is not going to be far. We're not placing our stop loss below this structure because we know our liquidity areas, they are likely going to end at this point right here. And you can see the bit try to play that by trying to push the market the farthest direction that they can so that they can take out all the trade traders that we are also hoping to this buy. You have to understand another thing that you have to understand is Forex is just a zero-sum game. For some to earn money, some have to lose money. You have to understand that way because some people can say, if we are not selling any product in Forex trading, how are they making actual money? You have to understand that this is a zero-sum game. For some to make money, some have to lose money. That's the way those Wall Street guys or those guys into the financial institutions, how they trade. So what are the lessons from this analysis up to now? You have to understand that discipline always beats impulse. All right. If you know the exit area for you to enter, obviously you're going to be disciplined as because most traders lose because they just cannot wait. They react emotionally and end up over trading. But with planned entries like this, we just buy limit orders at key zones and they will flip the script for you. You control the risk, you enter at optimal price, you stay calm and let the market do the work. Every winning trade isn't just about profits. It's proof that sticking to a specific strategy will eventually pays you off. Whether you are a beginner or an advanced trader, remember, success comes from preparation, from patience, and execution. So next time, don't chase the price. Set up the trap and let the market come itself to you. If you've learned something valuable today, do me a favor, smash that like button, subscribe, and turn on the notifications so you never miss out on fresh trading strategies just like this one. And if you want even more real-time backup, tips, and exclusive insights, you can join my Telegram group, whose link is in the description below. Thank you for watching, traders. Until next time, stay sharp, stay disciplined, and happy trading.